Lesson 11, Introduction to the Income Statement. Let us quickly recap the primary concept behind the income statement, which is the accrual and the cash basis of accounting. Under the cash basis of accounting, revenues and costs are accounted when cash is either received or paid respectively. Let's look at an example. Let's assume that on 20th January, Robert sells goods worth $500 to John. And on 5th of February, John pays $500 for the sale made on 20th. And on Feb 25th, let's assume that Robert sells goods worth $800 to Bill. Under the cash basis of accounting, the sales for January is the cash actually received in January, which is $0. The sales accounted for February is the cash actually received in February, which is $500 for the sale made in January. Please note that here the transaction on Feb 25th, which is goods worth $800 sold to Bill, is not yet received and therefore not yet accounted as sale under the cash basis for the month of February. The next concept is the accrual basis of accounting. Under this accrual basis, revenues and costs are accounted as and when the transaction takes place and not when cash is actually paid or received. So under the accrual basis of accounting, the sales for January is the sale that actually happened in January, irrespective of whether cash was received or not. So the transaction of Jan 20th is accounted as a sale. Similarly, the sales for February, the transaction for $800 which happened on Feb 25th is accounted as a sale. Let us look at some more examples. Joe buys logs of wood worth $5,000 on credit. That means there's no cash involved. So under the cash basis, there's no entry, whereas under the accrual basis, it's accounted as a cost or a purchase. Joe makes furniture and pays $500 for labor. So under the cash basis, it is accounted as an expenses because cash has actually been paid. And of course, under the accrual basis, it is accounted for an expense as well. Joe sells the furniture on credit for $8,000. Under the cash basis, no entry because there is no cash inflow, whereas on the accrual basis, it's accounted as a sale. Joe employs an accountant to account his transaction, and the accountant produces an invoice of $120 for the accounting work, which is not yet paid, and therefore no entry in the cash basis, whereas on the accrual basis you have an accounting entry. Finally, Joe's taxes are due for which no payment has been made. Under the cash basis, no entry because no cash outflow, whereas on the accrual basis, it is accounted as a liability. So how does this impact the income statement? Most businesses use the accrual basis of accounting. In some countries, cash basis of accounting is not permitted for legal entities such as corporations and companies. Therefore, it is extremely important to understand the basis on which accounts have been prepared, and therefore it is essential for us to understand the difference between the accrual basis of accounting and the cash basis of accounting.